Rev your engines as the U.S. car market is about to take a thrilling turn. In just a matter of months, we've witnessed a dramatic shift. From soaring heights, where average car prices reached record-breaking levels last summer, we're now hurtling towards an oversupply of vehicles. The stage is set for an epic battle of affordability as dealerships compete fiercely to capture your attention and offer unbeatable deals. Say goodbye to the days of exorbitant price tags and get ready to navigate a landscape where bargains reign supreme as the market gears up for a fierce showdown. So buckle up and prepare for a wild ride as we delve into the exciting world of the U.S. car market crash. In this journey, we challenge assumptions, examine evidence, and uncover the fragile state of the car market. Let's embark on this journey together. But before we continue, we would like you guys to subscribe to the channel, like this video, and hit the notification bell icon so you do not miss out on any amazing and entertaining content. The global pandemic that erupted in early 2020 has brought about profound and lasting changes across the world. It's remarkable how numerous things became scarce and increasingly expensive due to soaring demand. The automobile industry was not spared from these effects, and it's crucial to grasp the reason behind this transformation. One key factor was the chip shortage, which halted the production of new vehicles, consequently driving up prices in the used car market. It's worth noting that this shortage was a direct consequence of the COVID-19 pandemic, and the subsequent Russian invasion of Ukraine only exacerbated the situation. However, time has a way of healing wounds. While these challenges may seem overwhelming, they won't exert perpetual pressure, and certain aspects of life have already started to improve. This doesn't mean that the world will return to its pre-pandemic state, but there may be some relief on the horizon. By understanding the root causes behind the surge in the car market, we can monitor the changes within those causes and potentially predict a more favorable shift for prospective buyers. In 2020, it was an undeniable fact that a recession was upon us. As a result of the COVID outbreak, widespread stay-at-home orders became the norm. People were simply not moving around as much, and consequently, the need for cars diminished significantly. Many individuals were working remotely or faced unemployment. Unlike the Great Recession of 2007 to 2009, the economy was not burdened by high gas prices or credit lending issues. Nonetheless, between March 15th and April 4th, 2020, a staggering 16.8 million new unemployment claims were filed. With reduced travel requirements and millions of people unemployed, selling cars became an uphill battle to say the least. Dealerships resorted to offering unprecedented loan terms such as 0% interest for 84 months. These types of incentives were necessary to close deals. Generous purchase and lease packages were made available to attract new buyers. Dealerships would go to great lengths to ensure their survival, recession or not. Even the physical closure of businesses, though undoubtedly a hurdle, did not render sales completely impossible. Nevertheless, during such uncertain times, purchasing a car did not rank high on people's priority lists. It required financial means, even with low gas prices, which in some places dropped below $1 per gallon. As a result, dealer inventory, referred to as days supply, swelled to over 90 days, well above the typical 60-day threshold. Despite having an abundance of vehicles, sales proved to be a challenge due to the unique circumstances stemming from the pandemic. Fortunately, as restrictions were gradually lifted in 2021 and normal operations resumed, the situation began to improve. However, if you hadn't managed to purchase a car by the first quarter of that year, you missed out, as both the new and used car markets experienced an explosive increase in prices. This surge in prices was primarily driven by the supply issues with new vehicles caused by the chip shortage, which subsequently sparked high demand for used cars. Additionally, the lingering effects of the pandemic on the job market further strained new car production. Then, in early 2022, the Russian invasion of Ukraine occurred. While warfare always brings about numerous tragedies, it also leads to serious and lasting consequences. One such consequence was the impact on wiring harnesses assembled in Ukraine, which disrupted European production and consequently reduced the allocation of vehicles from European manufacturers to the United States. The global pandemic, chip shortage, and Ukraine war have left a lasting impact on the car buying experience, shaping the market dynamics over the past couple of years. The consequences are evident in the staggering price increases. In January 2022, new car buyers paid over 12.2% more compared to the previous January, while used vehicle prices skyrocketed by over 40% year over year. Startling statistics from Edmunds reveal that a whopping 82% of new car buyers had to pay above the sticker price in January 2022, a significant jump from just 2.8% the previous year. It begged the question, when would these inflated car prices subside and return to the pre-pandemic era, where consumers enjoyed red-hot deals? Unfortunately, there is no immediate relief in sight. Much of this can be attributed to the chip shortage, which has severely impacted new car production. These tiny, yet crucial chips power various systems in modern vehicles, including engine functions, infotainment systems, and even memory data for power seats. The chip shortage was ultimately driven by the impact of COVID-19 on the supply chain, revealing the heavy reliance of automakers on these chips for their vehicles' operations. As a result, it became clear that manufacturers would struggle to produce enough vehicles to meet the overwhelming demand for an extended period. While it is likely that we have already surpassed the peak of these exorbitant prices, predicting their future trajectory is far from straightforward. Wholesale prices have started to decline, which should eventually lead to a reduction in retail prices. However, the challenge lies in the fact that the initial benchmark was set at such elevated levels that it will take years to return to pre-pandemic norms. The chip shortage and the consequences of the tumultuous years of 2020 and 2021 have had a profound impact on the market, with vehicle sales reaching 4.5 million and 14.9 million units, respectively, compared to the typical 17 million unit market. The unfulfilled desire to purchase several million vehicles over the past few years has created a significant impact on the used car market. Typically, pre-owned cars become available around 3 years after their initial release when leases expire. As a result, the supply of used vehicles in 2023 and 2024 will be notably lower, leading to higher prices compared to 2 years ago. Although there has been a slight decrease of 1.1% in the average price of new cars, it still hovers above $48,000. However, there is a noteworthy development. For the first time in 20 months, the average price of a new car has fallen below the sticker price. Over the past couple of years, the average price of new cars continuously rose, often fueled by dealer markups. In 2023, the availability of new vehicles is gradually increasing, leading to the return of incentives. With more vehicles on dealership lots, competition has intensified, making it difficult for dealers to demand the same elevated prices as before. According to a recent report from UBS, global car production is expected to outpace sales by 6% this year, resulting in an excess of approximately 5 million vehicles that will require price reductions to be sold off dealership lots. While these price cuts may not occur until the latter half of 2023, automakers are already gearing up for a potential price war, with some electric vehicle (EV) manufacturers already slashing their prices. In a note to clients, UBS highlighted the potential risks of overproduction and increasing pricing pressure due to optimistic production schedules. The report stated that the price war has already begun in the EV sector and is anticipated to extend to traditional combustion engine vehicles in the second half of 2023. The analysts predict that makers of family cars will be most affected by these price cuts, while luxury car manufacturers are expected to fare better in this competitive environment. The combination of rising energy costs and high prices has made it challenging for EV makers, leading to a potential major impact on their market position. In response, Tesla has already reduced the prices of its vehicles in the UK, with some of its more affordable models now in a similar price range as mass-market brands like Kia. Other car manufacturers, such as Ford Motor Company and Lucid, have followed suit by lowering their own EV prices in response to Tesla's moves. Moreover, there are indications that car prices in all segments have started to soften. Recent data from Cox Automotive reveals a 2.4% year-on-year decrease in wholesale used vehicle prices in March, although there was a 1.5% increase compared to the previous month. Similarly, a report from Kelley Blue Book found that new vehicle prices experienced a decline for 3 consecutive months, suggesting a potential sustained trend. However, it is important to note that prices still remain historically high despite these recent fluctuations. It looks like we are finally approaching the projected time frame for a significant correction in the car market. While the presence of the ongoing COVID-19 pandemic and the conflict in Ukraine continue to impact the global landscape, the supply of vehicles is gradually improving. It may be tempting to place an order now and secure a preferred vehicle configuration, but the current market conditions remain unpredictable due to various external factors. It would be good to exercise caution and wait for the market to stabilize before making any significant purchasing decisions. That's it for today's video. We hope you found this video insightful and informative. If you enjoyed this content, make sure to give this video a thumbs up and subscribe to our channel for more in-depth analysis of global economics and finance. What do you think about this crash? Let us know in the comments below. Thank you for watching, and we'll see you in the next video.